Hey, everybody, and welcome back to the Microscope podcast by Teloscope Advisors. I am your host and the founder of Teloscope Advisors, Julia Brown. Today, I'm excited to share that I have Jeff Wise on the show with us. Jeff is leading the initiative at OPUS to build out an advisory practice. Been there just under a year, but has a ton of experience in the industry, from secondary to compliance to a whole bunch of areas that we're going to get into today. So I'm really excited to have Jeff on. It'll be about a 20 to 30 minute episode. So buckle up and get ready for a great conversation. Hey, Jeff, welcome.
Thanks, Julia. Pleasure to be here. I appreciate the invite.
Yeah, absolutely. I was hoping that you could start off with telling us a little bit about your background. I always like to start our conversations with getting to know the guest. Kind of want to feel like we've got a friend in anyone's, home or car or office, wherever they're sitting and listening.
Sure, be glad to. So I've got 20 plus years in the mortgage and financial services industry. I'm stopping at 20 plus, even though it's quite a bit more than that. So I've spent the last 12 years on the advisory consulting side. Most recently joined OPUS last September. So before that, I spent time with several different pretty large firms in the industry. Chase, Bear Stearns, Countrywide on the capital market side, Countrywide broker-dealer, Fannie Mae, Freddie Mac, and Wells Fargo. And actually began my career as a bank examiner with the OCC.
Wait a second. Wait, that's how you started your career? You weren't like a line level cook like me? You weren't a DTC loan officer?
I was not. I was a low level bank examiner. So,
That's amazing.
honestly, Julia, it was probably one of the best decisions I've made in taking that role, because I learned so much in a very short period of time. I was there for about 5 years, and it was on the heels of the commercial real estate crisis. So they relied on people like me who didn't really have much experience. So honestly, I feel that was a great kind of takeoff or platform to the rest of my career. So really enjoyed it there.
Launchpad. Yeah. What a cool launchpad. And so tell me a little bit about OPUS. What do you guys do? What's your core services?
Sure. So OPUS is a industry-leading third-party review advisory firm, TPR firm. OPUS was originally founded in 2005. We were, I guess, what our CEO likes to call refounded in 2022. He acquired the company then from an offshore firm called Wipro.
Okay.
And has basically built out the organization beyond TPR, rolling out additional services, including advisory, fulfillment services on the origination side, looking to expand on the servicing side. So Sanjay Agnihotri is our CEO, and he's got a great vision. So it's a growth opportunity. I'm really excited to be here, and we've had some clients that have been decade-long client. Our management team has an average of over 20 years of experience, so we're very, very experienced in the mortgage industry. So it's a great opportunity for me personally, and I'm excited to be here and in the industry representing OPUS.
Oh, so Sanjay comes in, acquires the company in 2022, brings it back stateside, it sounds like, and then expands the services from there.
That's correct. So even though that's the core service is TPR, we are just not a TPR firm anymore. So we can provide any number of different services to our clients. So
Okay, cool. And if you don't know this, that's totally okay. It's only been a year, but I'm just wondering, is Sanjay a mortgage guy background or?
Yes, he is. Well, he's got a really diverse background, a great background. But before he acquired OPUS, he had started a mortgage fulfillment operation. So he does have a great background on mortgage coming into OPUS, and really an extensive background beyond that. So.
Okay. And what percentage of the business would you say today is still that TPR?
Oh, TPR, I would say I can't say for certain. It's definitely the vast majority right now.
Yeah.
Again, advisory, we really formally kicked that off late last year when I joined. So we're still growing that on the fulfillment side, on the origination fulfillment and servicing fulfillment as well. We're growing those services. So right now it's still primarily in terms of the services we provide, the revenue comes from our TPR. But again, that is expanding and diversifying quickly as we speak. So
Yeah, and it sounds like you've got a refounder who has
we do. A
who has
refounder, yes.
success with the fulfillment services side and faith in your ability to build out the advisory practice with 12 plus years in advisory. I am going to get there in about 10 years. I'm about 10 years away from 12 years of experience in advisory specifically.
Oh,
Uh,
to be young again.
so I guess that leads me to this next question, which is like, um, from your seat, what does it take to be successful in the advisory space? Well, what are some of the things that you think matter to be successful in advisory?
Yeah, that's a great question. So, kind of what we bring to the table, I think, and this is beyond the experience, right? We've got so much experience internally. We have great
Sure.
technology. But other firms do as well. What we think differentiates ourselves from our competition is really our ability to be really flexible. We're not like some firms that come in and say, "Okay, here's a
Mhm.
solution we can provide, kind of take it or leave it." Now we'll adjust, we'll modify our solutions to what our client needs. It could be a quick 2-week assessment. It could be a larger, process reengineering project. It could be a compliance look back. It just really depends on what the client needs. So
Mhm.
we're very flexible. And again, we're leveraging the relationships that our management team has so carefully built over the last 2 decades, 2+ decades, really. So, really, at the end of the day, we just want to provide additional value to our clients. They may use us as a TPR right now, they may not. It doesn't really matter, honestly, from our standpoint. We're very, very confident we can deliver any sort of advisory solutions they need.
Let's dig into that because I've got a really diverse group of listeners within the Microscope podcast. So when you say TPR, define that for me. Explain what that means.
So, third party review, it's really due diligence, loan level due diligence, kind of a focus on credit and compliance. For securitizations, it could be for whole loan trades. There are certain regulatory requirements requiring independent third party reviews. So that's the core business. So again, when you look at our kind of the what comprises the vast majority of our staffing, it's people with strong underwriting, quality control background, et cetera. So that's the core business, and that's really, again, that's what we were founded to do back as early as 2005, and what Sanjay has grown since he refounded the company in 2022, and we're going from there. So,
And so the fulfillment services and the advisory services, are they in line with that? Is it compliance and underwriting based predominantly, or what areas specifically around advisory are you guys really focused
so
on?
So we have three key areas in advisory that we focus on. The first is business process transformation, really, around workflow strategy, redesign, really helping our clients get to the future state that they envision for their operational processes. So that could be, coming in, just taking a look at their processes, determining where they can improve or enhance. It could be a people issue, a process issue, a technology. It could be any of the three, really. But it also could be project management support, training,
Sure.
policy, procedure development, really anything our client needs, we can help them out. And we're going to leverage our internal expertise and resources to deliver a very, very high quality product. The second line is focused on risk and compliance. And our primary focus really has been around compliance testing on the servicing side, doing operational reviews, counterparty support. But we'll also provide support around developing and enhancing risk management frameworks. Could be an operational, enterprise risk, compliance risk framework. Could be control design and effectiveness testing. So really, anything our clients need from a risk and compliance perspective in order to, help them not only enhance their risk management processes, but also, deal with the regulatory pressures that are out there on a day in and day out basis. As your clients face, even with the CFPB kind of, I don't want to say going away, but taking a back seat, you
Yeah,
still have a
right.
lot of pressure from the state regulatory agencies, et cetera. Compliance is always, a key issue for our clients to deal with on the origination and the servicing side. And then the third piece is really third services around technology and automation support. We could provide support around due diligence, any sort of implementation support on both the origination or on the origination, servicing, or capital market side. And as well as maybe UAT testing or whatever our clients need in order to enhance their technology footprint, we can provide services to support that.
It's interesting to me. And I think that one of the areas that I am curious about is through through the lens. Are you looking through the lens of um, optimizing for least risk overall, or are there different risk tolerances and thresholds for different clients that you optimize for?
Well, that's a very good question, actually. The risk tolerances that we would optimize for is really driven by the risk appetite of the organization.
Hmm.
So some organizations have I guess a higher risk appetite or a lower risk appetite, depending on how you define that. So it really depends. So again, what we'll do is we'll come in, we'll take a look at their risk framework, how they're managing their risks, the nature of the risks that they're taking on a day-to-day basis. And we will advise them on the best ways to help control those risks, mitigate those risks on an ongoing basis. But it is a good question because it really depends on the nature of the organization. Some in a higher growth mode may be willing to take more risks than others that may be more mature. Banks have a greater risk, I guess you could say.
Aversion,
Was that?
aversion. Banks are
Yeah,
very.
yeah. Basically, you're talking about federal regulators as well as
Yeah,
state regulators, as
yeah,
opposed to independent mortgage banks that don't necessarily have the federal regulatory oversight that banks have. So banks tend to be more risk averse than
yeah.
independent mortgage banks at times. So again, it depends on the nature of the organization, the nature of the business, and really their risk appetite and what they're willing to take on from a risk and compliance standpoint.
Yeah, you're fine tuning at this point, it sounds like, for the needs of the organization. And I would imagine that it matters that you have a good understanding of every partner that you work with, every client that you support, and really what their philosophy is towards securitization and risk
Yeah.
before you start engagements.
Yeah, that's exactly right. Everyone is different, and when we go in and we look at let's say we evaluate a risk framework, we look at it from a kind of a maturity spectrum point of view. How mature is their organization, and what they need to do to get to the level of maturity they want to get to? Not everyone needs to have a risk management framework like a Chase
Yeah.
or a Citi or a Wells or something like that. So it just again depends on the size of the company, the nature of their business, the risks they take on a day-to-day basis, and really what kind of risk profile they want to have at the end of the day.
So, do you guys advise ever on like really what is an appropriate level of risk appetite for these companies based on their size, their book, etc.?
We do. Good question. So when you think about risk appetite, it really falls under really a governance framework, right? It's, tone at the top starts with the board and senior management, establishing what that risk appetite is, the level of risk that they're willing to take on a day-to-day basis, and then what they're doing to enable their management team to help execute that vision. So,
Yeah, and I've experienced this in the advisory space with different organizations having a different appetite for
yeah,
risk, different solutions, and
correct.
moving at different speeds too, right? Not every organization is moving at the same pace. So it's been a really fun learning for me to see because from the sideline, I'm saying from the sidelines, you know how it is when you're in an advisory capacity, you're with it, you're in it with them, but
Yep.
they've got so much skin in the game. And to see kind of how different companies play and move and manage the field is really interesting. And I just love the opportunities to come in and help them kind of shape and design what it is they're willing to do and how.
Yep. Yeah, absolutely. It is. I mean, I get a lot of satisfaction out of it about helping our clients to really get to the kind of the framework or the vision, if you will,
That's right.
of how they're going to manage their risk, not only from a compliance and operational, but credit, enterprise risk, and at the end of the day, a lot of it's about reputation risk, right? So helping manage that as well. So, again, no two organizations are alike, it seems like, in terms of what they want their vision to be from a risk management framework. So we're going to adjust based on their wants and desires. With that being said, if we feel like they're short in a certain area or they could enhance a certain area, we're certainly going to let them know based on our subject matter expertise, our experience, that, hey, we think you should, create stronger controls, create stronger testing in this area, or consider this type of inherent risk that you may not consider as part of your risk management framework right now.
Yeah.
So really, it's just a combination of those two things: meeting the needs of the client, but also providing, subject matter expertise, which we have a lot of internally, saying, you could do this better or that better, and really, at the end of the day, sleep better at night because your risk mitigation tactics are stronger.
Well, and I want to talk about the fulfillment side too, because I think you've got the testing, the advisory, the fulfillment. They're complementary pieces, it seems like. But first, a word from our sponsor. This is my dog. Her name was Zoe. It is now Sausage Patty. My 4-year-old renamed her recently.
All
Uh,
right.
and she is the Telescope company mascot. Whenever I get on a podcast, she gets anxious and comes over and says hello. So for anyone who's watching on YouTube, this is Sausage Patty,
All
our,
right.
uh, our mascot. Jeff, do you have any pets?
I do not have any pets right now. I have been a lifelong owner of dogs, so don't have any dogs right now. But I certainly miss having a dog. So
Yeah.
just like the day to day coming up and jumping on your lap or your knee a little bit and petting them. Yeah, I do miss that. So,
I mean, now that I work from home, she really is like my colleague here.
yep.
I've got my telescope shirt on here, and I need to get her like a little bandana or something, a little telescope bandana, so she can be in another swag.
Absolutely, get some bling for the dog. So for sure.
Oh yeah. Oh yeah. All right. So we've got the testing component, we've got the advisory piece, and then this third arm or third leg of the stool, let's say, it sounds like is the fulfillment piece. And so what fulfillment services are being offered now at Opus?
So right now we offer origination, anything on the origination side, really kind of soup to nuts, any sort of kind of outsourced service that our clients need. On the servicing side, we're actually in the process of developing that and rolling that out. But again, anything our clients need. We're talking to a client right now about supporting them on partial claim releases and servicing.
Mhm.
Somewhat nuanced, not a huge piece of servicing, but still they need that support. So again, look at any sort of services that our clients could use support on from an outsourced perspective. So just it runs the gamut.
How do you guys staff for all that internally?
Well, we have a team, an onshore team,
Hmm.
and we have an offshore team as well.
Hmm.
So we leverage resources for both of the for on both the onshore and offshore side. If we get a client and we feel like we don't have sufficient resources, we'll bring on those resources. Some clients would rather keep everything onshore, so we'll go ahead and adjust our resource capacity plan to address that kind of requirement. So if they're okay with going offshore, and we got a very vibrant, a very successful offshore program, so we can leverage that as well. So
But I think it's important to have these levers that you're able to pull, and for this to be, truly like an expanding business opportunity within our space, because the IMBs, especially, I predominantly work with IMBs, a couple banks and a credit union, but the
yeah,
IMBs have all these constraints on their revenue. The cost to originate is an ever evolving, challenge that seems like kind of a Rubik's cube for most companies. Plus the advent of the AI and the push for additional automation, and a lot of times we're carrying the labor expense plus the tech expense for a lot
yep.
of these organizations. It does seem like this is a scalable alternative where we don't have fixed labor expense for companies. Tell me what you're seeing from your clients. What are they looking for when they come to you guys for these fulfillment services? Is it to help with, the cost of origination? What's driving the demand there?
At the end of the day, it's really about the cost of origination, really,
Mhm.
at the end of the day, or the cost of servicing, right? All the factors you just mentioned, I think, lead into that. You've got the interest rate environment, you've got housing affordability issues.
Yeah.
You have obviously just the constant need, based on all those challenges, the constant need to ensure that your processes are as efficient as possible, and you're leveraging technology to the greatest extent possible.
Mhm.
So that's what we bring to the table. We have state of the art technology. To your point, we can provide kind of a variable cost type of approach where they won't necessarily, don't have the fixed costs that they need to manage on a day in and day out basis for their entire operation. We can help relieve some of that stress, and another advantage of outsourcing, as you probably know, is from a compliance standpoint is given the nature of our business, our core TPR business, we have a ton of internal expertise around compliance and risks.
Mm.
And, compliance, the requirements, the risk associated with that, it's not going away. It's not
Yeah.
decreasing. I think there was a thought when, the current administration came in and the CFPB took their foot off the wheel, so to speak,
Hmm.
off the pedal, I should say. Um, that maybe the environment out there would loosen up a little bit from a compliance
Right.
standpoint, but it hasn't. As you know, in talking with your clients, I'm sure as a matter of fact, in some cases, it's gotten more arduous and more challenging, just given the kind of the stance that a lot of the states are taking.
What would you say that stance is?
Well, they're being more aggressive, asking more questions. That's the feedback we're getting a lot. They're not necessarily seeing an increase in the number of examinations. They're seeing an increase in the amount of information they're being asked to provide, and basically the number of questions are being asked around their operations, et cetera. What I gather from talking to our clients is just more of a microscope on them from the state regulatory perspective. So,
Yeah, I'm hearing the same. I'm hearing it's a finer tooth comb, right?
yep, exactly.
We're not
Absolutely.
necessarily brushing more times, where it's just a finer tooth comb we're brushing.
Yeah, and I think, back when the CFPB was kind of the primary regulator, I think the states kind of would rely on them to come in and do all the heavy lifting, the dirty work, so to speak.
That's
But
right.
now that they're not as nearly as active anymore from an examination standpoint, the states are definitely playing that role. So,
Yes, I think so too. Um, and I would just say, you know, I think there's a lot of interest right now in servicing more broadly and how originators can partner with servicers
mhm,
to own more of the, ecosystem. And
yeah.
I don't know if that comes into play in your world at all, if you're seeing any of those mergers or acquisitions, or, if you have any thoughts in, are the servicers who are going to win long term the ones who are partnered with an originator, or I don't know, what do you think?
Yeah. Well, I think from an economic standpoint for any company, anytime you have that macro hedge, when you have the origination and the servicing side, it's a net benefit to you, right?
Mhm.
Rates go up, originations may dry up, but your MSR value will, potentially increase. There's obviously a number of different factors that go into MSR valuation, but that's a true advantage. But you also have to retain those clients. They're focused on recapture.
Mhm.
And at the end of the day, it's also the cost of service. We talked earlier about the cost to originate, the cost to originate. It's really the cost of service as well. And that's where leveraging technology really comes into play. And it's not just AI, even though that's obviously the flavor of the week for the last couple of years, I guess, and it probably will be for a while. But really any instance of technology, ensuring that they're operating as efficiently, as effectively as possible, and our clients are getting the most out of the technology that they do have. So, go ahead.
I just had this thought. I'm sorry, I didn't want to interrupt you, but I had
No,
this.
no, go ahead.
I'm curious if you have this macro data. I do not at this moment. I'm wondering if you know, on average, how long it's taking our servicers to break even on the servicing. Um,
I don't know that right now. So, and again, given the MSR valuations, et cetera,
Mhm.
obviously with rates, during the pandemic being at all-time low, if you're, retaining those MSRs with those values, those are pretty good right now. But again, it depends on the nature of the book that the servicer has, right?
Yeah.
And again, it also depends on, and this is where I think we're seeing so much activity from an M&A standpoint. You alluded to it earlier, particularly on the servicing side. Look at Rocket and Cooper, right? Look at
Mhm.
what's going on with Two Harbors.
Oh yeah.
Summit.
And
It's
the
just
UWM versus cross country.
yeah,
Yeah.
exactly. It's everyone in the industry is looking for greater efficiencies on the servicing side. It may be enhancing your processes. It may be enhancing your technologies. It may be, acquiring a book. It could be an entire book. It could be a portion of it. It just really depends on what the servicer wants to do in order to maintain it. But, I mean, at the end of the day, it's just still such a challenging market for originators and servicers. And I don't think it's going to get easier anytime soon.
Well, and I wonder too, like when, I mean, obviously we don't have a crystal ball. You can't predict the future, but I'm curious if you have an opinion on um, when would a servicing book become a liability? If you were an originator and you went out and sought a book and you got servicing, under what circumstances does that become a potential liability for your origination side?
Well, I think first and foremost, it could become potential liability, obviously, as default activity increases, right? That's the biggest risk for a servicer. You look at the core servicing activities, the cash management, payment applications, escrow. Of course, there's risk related with all those. But when you start getting into the default timeline, collections, loss mit, into BK, foreclosure, REO claims, all that, that's where servicers could really take some hits if they don't have an effective process in place, if they don't have good technology in place. So that's what we talk to our clients a lot, especially as we're seeing, delinquencies start to rise. They have been rising, particularly on the Ginnie Mae side. Everyone knows about, the pressure that consumers are seeing. And so I don't think anyone expects the world to change overnight. I don't think anyone expects a repeat of 2007, 8, 9, and 10 and up through 2012. But everyone does believe, our clients that we've talked to, that there will continue to be pressure on servicers to ensure that their default servicing practices are as strong as possible. So,
Uh, it's interesting that you bring this up because one of the things that just keeps coming to mind for me is the affordability component. And just like everybody else, I refinanced in 2021 and thank God I did. I refinanced. I've been in my house for 8 years, but I dropped my payment by like $600 in 2021 by refinancing.
yep.
And now my payment is $1,200 higher than when I refinanced. And so if I wouldn't have, holy smokes, I'd be $2,000 a month higher. There is an affordability issue, and homeowners insurance, obviously claims are on the rise. We're seeing more issues around insurance claims
Yep.
and taxes. I think property taxes across the nation are on the rise too. And I wonder if there's anything that servicers are doing or could be doing proactively to partner with, either insurance carriers or to try to find ways to help make sure that people's payments are as affordable as possible as part of their loss mit.
Yeah, I think, and you bring up a great point that, I think maybe the kind of the standard consumer, when you think about affordability, you think about housing prices and interest rates. Those are the two big things, right? The
Mhm.
cost of purchasing a home,
Right.
and, your P&I payment. What I think a lot of people don't think about is that T&I component, right? The taxes and insurance. I live in Dallas, Texas, and and I don't think we're unique in terms of how insurance costs and taxes have increased significantly
That's
over
right.
the last 10 years. I mean, the pandemic was great on the origination side. A lot of folks, in most geographic areas in the country saw increases in their home values, but with that comes increases in taxes.
Hmm.
Obviously, insurance costs have continued to increase. So it's just amazing. You just talk to the standard consumer out there.
Right.
I'm talking about corporate. Just talk to them, and I don't think there's anyone who's owned a home since over the last 10 years who hasn't seen a significant increase and feels pressure
Mm.
from a payment standpoint. So you're right. And in terms of what they can do, from our standpoint. And I think it's the challenges that they're facing is to ensure they're as efficient, as effective as possible from a process standpoint and leveraging technology. It's just that's the easiest way in a short-term basis to make sure that you maintain a reasonable cost of service.
What about the role of subservicers?
So that good. It's a good point because we talk to a lot of folks that have subservices. I mean, listen, building out and maintaining a servicing shop in house it's a significant capital outlay. So there's a huge cost associated with it. It's always challenging to, retain good people. Technology is expensive, things like that. So you've got your sub-servicers, obviously.
Sure.
You've got the big ones. You got Loan Care, Dovemule, Cenlar, which is now going with with PennyMac. That's right.
Yep.
And but still, you have a number of shops out there that are increasing their focus from a subservicing standpoint and their footprint. So, and we talked to a lot of folks that they have subservicers right now. They may not necessarily be happy with who they're using, but there's not much of a doesn't seem like there's much of a really a want or desire to hop into bringing servicing in-house just because of the costs associated with it. So I don't see subservicing changing from a perspective of people won't use subservicers to the point that they use right now. But I do see the players changing. Obviously, with Sunlar becoming part of PennyMac, and you have other companies coming. ServiceMac is a great example. They've been a good growth story over the last few years.
Yep.
And so you have other smaller players as well who are becoming more prominent that can provide the customer service that the servicer, the MSR holder, is looking for, that the bigger players may not necessarily provide to their satisfaction. So,
Mhm. Yeah, it's interesting to think about how to do this efficiently, and definitely if I were in the position of taking this on, I would be reaching out to you and to Opus.
yeah. Well,
20
that's
plus 20 plus years of experience on the TPR side with, a refounder who's got successful fulfillment expertise and a leader in the advisory space with, dozen plus years. You guys would be my first call, that's for sure.
Well, that's great. It's good to hear, Julia, and hopefully other people watching this will think the same thing. And you're right. It really is a true advantage where you have, and of course, I've been on the advisory side for a number of years. I was on the corporate side for a number of years, and
Yeah.
most people tend to have an expertise in one kind of specific area. I don't want to say it's myopic because we all do that, right? Especially
Sure.
on the corporate side. I was a risk management person. That was my experience. I knew risk management. I didn't really know operations when I was on the corporate side. So, but Sanjay, our CEO, he's got not only the TPR experience, but he's got that fulfillment side. He's got a broader view of the mortgage, kind of the soup to nuts mortgage process, and that's so important when we're helping our clients.
Well, and I've worked with a lot of organizations. More so, my stuff is, tech stack optimization, leadership development, M&A integration management. But I've worked with a lot of leaders over QC or compliance. And to be successful, there's this mindset stuck in our industry that if I'm going to be successful in QC or in compliance, there's zero risk, right? Like my job is to eliminate all risk. But the ones who do it really well are the ones who walk the line alongside of the ownership team, the board, the CEO, and understand philosophically this is the appropriate level of risk. No risk at all is not the answer.
No.
Um,
Yeah, no, you're exactly right. That's why we call it risk management, not risk avoidance, right?
yeah, there you go.
I mean, there is inherent risk
Yeah,
in the mortgage industry, just like there is in other industries. You can't diversify away. That's why, from a risk management perspective, you want to evaluate your inherent risks. Establish appropriate controls, and then
sure.
look at risk from a residual risk perspective, not an inherent. Because to your point, you're not going to get rid of all. Because if you're getting rid of all your risks, then you're not executing your business model
Mhm.
appropriately. That
That's right.
doesn't that doesn't exist in the mortgage industry, so it doesn't exist in most industries,
That's
so
right. And then there's always the human component, and we can't see the future. We're asking people to make a 30-year commitment.
exactly.
And we can't.
Absolutely, so
Um,
if I
let's
could, Julia, yeah, and maybe
yeah,
throw it back to
yeah,
you. So what do you with your clients, I know we've talked about the origination side, the servicing side, the challenges of the of the mortgage market. What are you seeing? Anything that we haven't talked about that you're seeing when you're talking with your clients in terms of challenges they're facing?
Oh my God. One of the things that I will never get sick of saying is that you can't take people out of it. It's people and profits.
Yep.
A lot of the clients that I work with when I come into the engagements, they're either centered on people. We're a people first business. We're a people first business. Okay, this is why you're losing money because your people first isn't actually getting you where you need to go.
Sure.
Or we're profit driven, we're profit driven, we're profit driven. And you don't have any heart and soul in your company. You don't have loyal people and you might be profit driven, but you're underperforming still. And so it is back to basics. For me, a lot of the work that I do is helping people to understand one another's roles and scopes and expertise and have a more full picture before they make decisions of really what the organization needs and what the organization's future is. And it's funny because whether we're in times of high volume or low volume at any given organization or point in time, we see these things start to fester, right? When we're making a lot of money, we can deal with some more problems. We can pay for additional tech components or additional personnel. When things constrict, now we're looking at every vendor agreement with a fine tooth comb. We're
Yeah.
going through every person, any little mistake any of our leaders make or anyone on their team makes. We're thinking, do we need this person really, or could we cut them? And trying to help people just know truly where their business is headed so that they can make decisions more quickly because they're aligned with what the business needs are. Um, and with that, I think a big portion is leaning into technology
Yeah.
in a way that's strategic,
Yeah.
um, and executing with little betas here and there in different areas of the business.
Yeah. No, that's a good point. It's funny. We talk to our clients and, they use terms like being strategic, being opportunistic. A
Uh-huh.
number of them have said, of course, we all know the larger players, especially the Rockets, the UWMs, from a technology standpoint, they've always been in the
Sure.
forefront from a technology standpoint.
Sure.
But other players, they understand the power of AI, but they also understand the power of people.
Yeah.
At the end of the day, it is a people business. It's funny. I was just having a conversation with someone like about this yesterday. Even though you could implement AI to, cover certain tasks, you still need people to make sure that, that the output is accurate, right? You may not need 10 people, but you still need people. But at the end of the day, it's the people doing the development and you can't diversify people out of the model.
That's
And
right.
I don't think and to me, the companies that are successful don't want to do that because
Mhm.
they realize, it is people first. It is their employees. They look out after their employees. Of course, sometimes you have to make hard decisions. You have to make cuts. You have to, it just happens. That's the nature of the beast. It always has been
Yep.
and it always will be, but you can't forget about the importance that an effective, person can add to an organization. So,
Agree completely. All right. Well, we are about up on time. I have one last question for you, Jeff.
sure.
What is the most fun that you have in your day to day at work? What do you like doing best?
Honestly, problem solving with clients, and it may not necessarily be from a delivery standpoint. It could be from developing the problem statement. Hey, have you thought about this or that? Just my colleague Adam Pick and I had a great meeting last week with a couple of his former colleagues. And just kind of going back and forth on some of the challenges they're facing in ways not so much that we could help them, but ways they could, also help themselves in
Mhm.
terms of, improving, process efficiency, improving profitability, lowering costs, keeping their people happy, right? Things like that. I mean, that came up as well. So, I love doing that. I love kind of the brainstorming. Of course, at the end of the day, we're all here to make money, right? We
Sure.
would all like the business
Sure.
and we want to get the business because we want to help our clients. We want to help them succeed. But I just love the discussions back and forth. I love, I've been doing it for a while. I love going to the conferences. I'll be heading to the MBA secondary here in about a week and a half and
Nice.
meeting with clients and prospects there and just chatting about, what are the challenges you're facing? What's keeping you up at night? And, and really digging into that. So that honestly is the most fun for me. And as you can kind of tell, I kind of like hearing myself talk. So it, it fits really well for me. So
Well, if anyone is looking to connect with Jeff either at the secondary conference or in general, I will go ahead and add Jeff's contact information here to the show notes. And then, Jeff, what is your preferred method for people to reach out to you? Email, LinkedIn, cell phone? What's your preference?
Really, any of the above. Honestly, LinkedIn or cell phone may be best. So I
Okay.
don't know if you want me to give that information or, but yes, email, is obviously effective as well. Really, whatever people need. So there's so many ways to contact us these days, right?
It
So
is so crazy. Well, I am going to be posting on LinkedIn a copy of this episode. It'll be on YouTube and Spotify. And so Jeff Wise with OPUS is who you want to search for on LinkedIn. Again, more details will be in the show notes. Jeff, thank you for being on today. I'm so happy to have had you.
thank you, Julia. Certainly appreciate the opportunity to come and great talking to you again.
Likewise. All right, everybody. Until next week, this is Julia Brown with Telescope Advisors.